And let me now bring on board Tom Elliott, Global Strategist at JPMorgan Asset Management. He joins us from UK now. Tom, good morning. Thank you for joining us. How would you characterize the current market environment and market action in EU markets?
From a political standpoint, I think we're seeing progress. The Stability Pact that's just been signed should help ensure that we don't get into this government debt mess in the future once this crisis is sorted out. The LTRO facilities made available by the ECB, we're hoping provide a big enough buffer in the event of a Greek default. I should add, though, that the underlying economics of Europe and indeed the UK remain weak, and we've just recently had some worse than expected Eurozone inflation data and unemployment data. And so there is, if you like, a disconnect from political progress and progress from the ECB on sorting out the crisis and the underlying pain of a grinding austerity that is going to go on for some years.
Tom, so what's your call on European equities in the short term? Seeing stronger numbers since the start of the year, do you think this is going to be sustainable?
I think part of the rally in European equities is sustainable, and that would be relevant to the sectors that are doing very well from what, let's face it, stronger than expected growth from the emerging markets. Emerging market demand has not weakened significantly in response to the high interest rate policies of last year. Instead, inflation has come down, demand has cooled a little, but is much stronger than many had feared it would be. And that's providing a good source of exports for whether it's German autos, French luxury goods, British high-end engineering firms. So that part of the stock market, I think, is on a recovery. And I should add persistently strong data from the US is also a boost, although the US is still growing at a lower than long-term trend. The other part of the recovery we've seen, which is a rally in financials, partly in response to that LTRO offering, I imagine is more short-term. It's a relief rally as financials that some people might have feared would have gone bust are now less likely to go bust thanks to that intervention.
Tom, what are your thoughts on precious metals, especially gold and silver?
Not overly bullish. There are two reasons why people might find gold interesting. One is a very legitimate theme of shortage of supply. It's getting more expensive and harder to dig the stuff out of the ground. And expanding demand as we see demand in Asia for jewelry and demand for gold and electronics goods increase. Now that should support the gold price. But there's another theme which has been driving it, and that's fear of inflation. And we don't believe that there are grounds to be afraid of inflation in the Western world as a serious long-term factor. And therefore, we're nervous of the current price. It's very difficult to know what the price should be if you just look at that first theme of fundamentally tight demand and tight supply and growing demand. But it's got very confused because of the froth of people buying what for us is the wrong reason, fear of inflation.
Tom, what about Indian equities? What is your view on valuations and the kind of returns that you're seeing on the MSCI index?
Yes, we've recently gone overweight in India in our emerging market portfolios. It's been an unloved market for some years, and indeed an unloved currency for some years. But we decided to take a bet on what is unloved is often offers good valuations, and we have been rewarded. The Indian MSCI India up 17% in the first 2 months of this year in local terms, and up an astonishing 28% in dollar terms, thanks to that rally in the rupee. So we do like India at the moment. We also like other Asian countries. This is the region where we've got the big economic giants of tomorrow that are emerging, and also Latin America and to an extent parts of Eastern Europe. And in all of those there's a common theme of, in most of them rather, of preferring the consumer sector rather than exporters. We think that household consumption in those sectors will follow the Western pattern of becoming a larger and larger share of stock market value and GDP, and so that's what we're targeting.